Hello and welcome to our latest Money Show MoneyMasters Podcast segment. I'm Mike Larson, Editor-in-Chief at Money Show, and today I'm speaking with Jim Iuorio, Managing Director at TJM Institutional Services, and Bob Iaccino, co-founder of Path Trading Partners. Jim and Bob are also the team behind the Futures Edge podcast. Guys, welcome to the show.
Thank you for having us.
Good to see you, Mike.
Hey, when I sit back and look at this market, sometimes I just think, what a time to be alive. I mean, we got the S&P 500 just broke 5,000. We got Wall Street all in on the soft landing story. You got stocks like ARM Holdings and Super Micro Computer that are trading like meme stocks. I mean, what's going on? What do you guys think of this environment?
I think it's a combination of two things. I still think there is excessive liquidity that was injected in the system during the COVID mitigation strategy. By my little thumbnail, there's still about $2.5 trillion in excess of what the money growth would have been had it kept on the same trajectory before everything started in 2020. So that's still in the system. I think a year ago, March, when we first started to see the bank stress, what's the first thing that happened? The Fed jumped in and restarted QE. They called it whatever that bank lending program was when they're buying the bonds at par. But the first thing they did was increase their balance sheet and come to the rescue. That sticks in people's minds. So I think people do still believe there's a Fed put, and I still think there's excess liquidity. I do still think there's a definite possibility in the next 2 months to have a quick 10 to 12% reset in the S&Ps. That'll be the thing that pushes the Fed off the sidelines. But right now, I think all systems go, provided you hedge, you take profit. I don't think if you get to be a pig here, we say, bulls can make money, bears can make money, pigs get slaughtered. Here is not the time to be greedy, but it's not the time to be short either, in my opinion.
Where Jim convinced me about is excessive money in the system theory quite a long time ago. And it kind of fit in with something else that I've been thinking about, is this sort of reflation narrative, where not only do we reflate in terms of prices, which we've seen some data that points to that, not a lot of it, not all of it, but you're starting to see a little bit of a spike in prices. We're still seeing wages grow, and they still have not caught up, by my math, with the overall level of inflation, with wages up 13% since 2019 and inflation at a general level up 18% since that time. So if we have an inflation narrative, here's where I should say reflation narrative. Here's where we run into the problem: the excessive debt in the US. Can that money continue? That's number one. And number two, can the Fed actually achieve the cuts that the market is pricing in? And if they do, stocks look great. Even if they don't, if we're reflating, stocks look great.
Let's unpack a few of those points there. I mean, as we're talking, we've just gotten ugly CPI, ugly PPI. Markets stumbled initially and kind of found their footing after the PPI. I mean, what is this data telling you?
So what's telling me is that one thing that Bobby said for a year and a half, I thought inflation was going to go away once supply chains were healed. And I think I was partially right. Bobby said it wasn't going to go away completely because there's too many factors that are going to push it higher. Bobby's partially right. At the end of the day, I think Bobby mentioned government spending. They are blowing out the national deficit spending like a bunch of drunken sailors, and it's accelerating as each month passes. To think that has to have a somewhat of an inflationary impact is perfectly reasonable. And I'll also throw in that M2 money supply. Remember, we had the 4.6% decline in M2 money supply 2.5 years ago. Nothing like that has ever happened before without a depression. Depression didn't happen, but now all of a sudden, since last May, M2 money supply is creeping higher, not lower, in this supposedly restrictive area that we're in. That's from government spending. That's part of what could be reflation. Can they keep borrowing forever at this pace? Absolutely not, but nobody knows what that endpoint is. Jay Powell seemed kind of scared about it when he talked about it in 60 Minutes, and I'm scared about it too, because by the time they realize what the endpoint is, it'll be so far past the time where they could have turned the ship around.
And this is really interesting, Mike, because what Jimmy's saying couldn't be better for stocks, to be honest, because we both have an inkling that the Fed might be a little bit political. Okay, let's just leave it at that level of conspiracy. But when you look at it from what Jimmy's saying, if they actually continue to spend, Jimmy mentioned drunken sailors. I think they're spending like the thieves who found the drunken sailors passed out and stole their wallets, right? Now they're additional spending that they're not able to do, they're doing. And when you add that in, you're looking at an almost unavoidable level of inflation. Now, if the Fed actually cuts based on their fear of a falling stock market, or let's say election, doesn't have to be that. But But if they cut a couple of times, which in my view, given where inflation is right now, is not justified, and given where the unemployment rate is not justified, I still think they'll do it. If they do that, what do we have? We have a suddenly steepening curve, because the further out part of the Treasury curve is going to start pricing in even higher inflation. And the Fed, which only controls about 2 years out, right? They have a dramatic correlation to the 2-year note yield, with Fed funds rate. When you see that, you get this shift in the yield curve, and that actually is good for stocks as well. So there's a difficult argument about trying to push a lower stocks narrative, which, and by the way, this doesn't conflict with what Jimmy said at all. Once the market realizes the Fed may only be able to cut a couple times, we're probably going to get that dip. That's probably a dip to buy.
Okay. I'm glad you guys brought up the Fed here. I mean, we could talk about it for hours, but to try and keep it on focus, interest rates, I mean, I think markets were pricing in a little while ago, 5-6 cuts in the year. Now it looks like somewhere in the vicinity of maybe 4 this year. Do you think that's right, wrong? And in either event, why?
Okay, so I'd like to address it in 2 ways. And first of all, I believe at the high it was almost 170 basis points of easing that the market was pricing in. And now it's probably about 90. I didn't check it today, but based on where I saw the SOFR futures trade, I believe that's about the case. So the one thing you have to keep in mind is that everybody, it's very, very convenient to look at the Fed funds market and say, well, the market is pricing in this many cuts. That's not exactly true, because it is a hedging instrument. So a lot of banks, risk managers tap someone in the bank and go on the shoulder and say, you have to hedge in case something happens. So they go out and they buy those futures. So when I look at the market that's pricing in 170 basis points, to me, it's probably really pricing in about 130 basis points if you kind of tease out that hedging thing. And I don't know if that makes sense to people. If you guys, it doesn't make sense to you, contact me at Twitter. I'll give you Bobby's cell phone number. You can call him and he'll explain. But it's been wrong for 2 years now. We, with people who are bond traders, and Bobby and I both cut our teeth in the bond market, we always talked about it as being the smart money. I don't believe it's the smart money at all anymore. I think it's the reactionary money. I think something has happened to the mechanism of pricing. That being said, Bobby said he has an inkling that the Fed is political. Can I swear on your show or no? I won't, by the way. But I think they are very, very political. They've proved it to us once in the past. They didn't start their hiking cycle till the day after he got his final confirmation. I think that they are political. I think they will try to keep the boat afloat in 2024, come hell or high water, and see what happens after.
I'll give you an example of what Jim's talking about, Mike. When you look at the CME Fed Watch tool, very easy, just go in Google or DuckDuckGo, whatever you use, type in CME Fed Watch tool, it's going to be the first one on there. You click on that, and then on the left-hand side, under target rate, there's compare and probabilities. You click on probabilities, and that gives you the next bunch of, I think it's the next 12, 10 Fed meetings, right? Yeah. Right now, they've got the highest probability being 4 rate cuts, right? As I look over here, because I've got it on my screen here, the July rate cut is priced in at a 37% probability. The unchanged level of rates is a 36. Okay, so it's pricing it in, but by this much. So you tease out things like hedging and stuff, and we would even say it's probably not priced in, looking at it from a trader's perspective. But when you talk about what the Fed should do and what the Fed will do, that's the political aspect. What we can't measure is, do politics come into play? And does the fear of an 8 to 10% falling stock market as we approach an election come into play? There's no tool we have to measure that at this point.
You know, while we're kind of in the weeds a little bit, but for good reasons on the bond market, you know, Jim, you've been talking on Twitter about, and this is a recent tweet, about how the Fed's overnight reverse repo balance falling represents low-hanging fruit for Treasury issuance, and you've talked about this issue before. Can you explain for listeners what you're looking at there, and you know what the signal is coming from that part of the market?
Absolutely. So every morning I punch up the reverse repo market, the accepted bids, whatever the chart is, but basically what it is, it's gone from 2.2 trillion and it's going down. Now it's about 490 billion. Now, the easiest way to do that, I could explain the repo market here about how it's, you know, exchanging cash for treasuries for a short period of time because one bank needs them, the other doesn't, and the Fed getting into it back in 2008 to stop the bleeding. That's all well and good. But the easiest way to look at it right now is that's kind of money sitting in banks looking for a home that they are looking to repo. So it's like a built-in demand for treasuries. So if you look at the last 3 months, the Treasury raises money by selling bonds. and they go, out the curve, they decide what they want. There's a need for us to deficit spend if we're going to have the world's reserve currency, but that's different level of weeds. But anyway, so they're taking the low-hanging fruit is the short end, going into just zapping all that liquidity that's in the repo market. When that goes to zero, and based on the trajectory of the decline, it should be within the next 3 months, let's call it. There's a couple different options they have, because within the last 3 months, they've tried to sell long in bonds, and they've been successful by a very, very loose definition of successful. There's been a couple of those options that have been sloppy, meaning the world is saying, provided the Fed's not going to be buying bonds from the Treasury anymore, we don't love them as much as we used to love them when we had the Fed at the back. So all of a sudden, if the market says we don't have the appetite for 10-year bonds, when they go to have to sell 10-year bonds, when the low-hanging fruit has been zapped, things could get a little dicey. What I expect to happen is if a couple auctions go bad in a row, the Fed will quietly end quantitative tightening, move back to quantitative easing. That's when I think things like gold, silver, Bitcoin, and eventually stocks will do quite well. Did I explain that okay? I mean, we don't want to go too deep into the repo market, right?
No, absolutely. No, that's great stuff. I mean, like I said, I figured we could talk about this for forever, but I think you summarized it pretty well for our listeners. Bobby, let me ask you a question about one of your issues you were talking about recently. I saw your segment on the cow guy close. You're talking about the AI fat finger trades. What happened with Lyft earnings the other day. I mean, can you expand on that? Like, what does this surge of algorithmic trading and sort of AI-based, extremely fast trading mean for the average man or woman trading this market?
Well, it means something very specific for me. First of all, I think algo trading and high-frequency trading, it's a little bit of a boogeyman for people. Back in the day, in the retail world, they called it stop hunting. Now, it's a completely different thing, but everybody had these ideas, and Jimmy and I have talked to institutions for years. Jimmy still does. Institutions were never calling us up on the trading floor and saying, where do you think retail has their stops? Never said it. Never once did I get that call. Institutions don't stop hunt. By the same sort of a logic, when people are fearful of what algos are doing, what high frequency trading is doing, that's actually a more realistic fear. We saw it in Lyft, where there was a misprint on their earnings call, I believe, where they said that their revenue growth was 5%. It was actually 0.5%. And the algorithmic trading signals that look up the language within earnings releases, and they calculate the amount of time something is said, or the amount of earnings growth, or the amount of profit growth is either a buy or a sell. Those exist. So what that means to me for the average retail investor, okay, and that's who I assume we're talking about, because anyone who's in the institutional world is not listening to me, right, is you have to shrink position size and pull your focus back out. Okay, one of the things that Jimmy and I did for years was get involved in short-term trades for a tick or two here or there and talk to guys that were doing that all day long. Yeah, I just got in at 17, I got out at 19, I got in at 16, I covered it at 15, I got in at 18, I sold it at 20. We don't do that anymore as individuals. We look for things that might last for anywhere from a few hours to a few weeks to a few days, in those ranges. Individual retail traders still want to say that I made $500 today and I went to the beach. But what you need to do is you need to shrink your position size and pull back. When you've got something like a Lyft, stock specific to what happened this past week, and it can go 30-35% on a fat finger, again, which is a mistyping of a part of their earnings report. If you're looking for a 40% gain in Lyft with a 20% stop, you might not be crushed by that, right? Smaller position sizes, more positions, and pull them back. Go to 30,000 feet in terms of your view of the stock, as opposed to 10,000 feet.
Mike, can I ask you a quick question? Do a lot of your clients use options too? Because Bobby and I both love options for defining risk. Do they?
Yeah, we have. I mean, at Money Show, when you look at what people are interested in, the different kind of programming we have, and options are always popular. I mean, both on the sell side and the buy side, frankly.
Good, yeah, because I think that one of the things Bobby's saying is 100% true. It is so difficult to trade against the algos on a minute-to-minute basis. I think it's much, much less difficult to back up, like Bobby said, and make my swing trades like a week long. That's what I always joke to people, and I have for years. When I trade money day to day, try to make money, I am very average, probably even over time, but lose a little bit of money. When I start to back that out to 2-week duration, even a week duration, the trades I put on today are for Wednesday and Friday. And, they're well thought out. They're used options. If I'm right, I'm right. If I'm not, I'm not. And then I don't have to worry about being washed out by the others.
And this is why, Mike, I try to get people to not have their only trading process be the ODTE options. Because basically you're falling prey to algos when you're involved in that. You'll make money 99 times out of 100, and then that one time that the algo gets you, you're going to lose everything and more. So fine to trade it, make it a part of what you do. But if it's not part of what, if it's your entire core thesis, you may end up with problems that you can't anticipate.
That being said, by the way, I mean, there are plenty of people I know who short-term trade and make a good living doing it. That's fine. I'm just saying it is, I still do it, but it's gravitated more my style of the 2 weeks.
Got it. Let's talk a little bit about, markets as they stand now as we're talking. I mean, what is there anything that looks particularly attractive to you across the different kind of asset classes? And on the flip side, anything that looks like something you want to stay away from?
So for me, the beginning of 2023, and I'm not taking a victory lap and patting myself on the back. This was my thesis. The moment BlackRock said that they were getting into Bitcoin and launching their ETF, I was like, well, I'm getting into Bitcoin too. So that's been one of my core positions for the last year and a half, and it's worked out quite well. Gold, I mentioned before, when I think the repo market's going to run out, then the Fed has potentially the Treasury has the potential to use their Treasury general account to cushion the blow. But as soon as all that runs out, and as soon as the Fed has to come back with quantitative easing to support the bond market, that's when I think gold, boom, explodes. And I think crude oil could do well too. Crude oil has been pricing in a global recession. It started to rally recently. I got to see some more thresholds to be met before I like it. And Bobby's more of a fundamental crude guy too. But I think crude looks very good to me as well.
Yeah, I'm going to piggyback off of a couple of things that Jimmy said. I agree That's
why I jumped in ahead of you, by the way, so I could get it in.
Well, I agree in crude oil in 2022. But I'm just going to say I agree on crude oil. We need more time to go into the fundamentals as to why, and we don't necessarily have that time today. But there's a lot of them. There's a lot of reasons why crude may be a problem for people who think inflation is done. Jimmy's moved out of that camp. That's number one. But also, Jimmy's convinced me that higher prices at the pump can be restrictive. And I have not been a fan of that thesis. He's convinced me otherwise as of late. But crude oil doesn't necessarily convert directly into prices at the pump. Again, I'm getting in the weeds. Yeah. In November of 2022, I did an interview where people asked me for my pick of the year, and it was gold. And gold performed very well in 2023. That was the year we were talking about. But it didn't outperform other things, like, for example, the Magnificent Seven. But that's not what I was saying. I was saying on a risk-adjusted basis, it was my pick of the year. I still like it for 2024 for another reason. Gold is not an inflation hedge when we have an activist Fed, okay? When we don't have an activist Fed, it is. And it inflates because it's an asset. An asset inflates when we have renewed inflation, okay? Reflation reflates assets, housing, gold, copper, machine equipment, everything that's an asset. If the Fed comes in and starts hiking rates because inflation has run away from where they are right now, gold will be killed.
No doubt.
And if they cut rates, like Jimmy and I both believe, gold will do well. So I'm going to stick with gold for 2024 because I think 2 out of the 3 scenarios, gold does well. I'm also going to throw in an ETF, if you don't mind. Is that okay to do on this show?
Please do.
I like an ETF called CALF. It's CALF. And it is a small cap cash cow ETF from Pacer Funds. And the reason I like it is because they use the S&P 600, which Jimmy Shana Orzik Seisel told us to look at the S&P 600. It takes the S&P 600 and pulls out the small caps that make money. Okay, they have cash and they make cash. And that's what they base their fund on. So, and honestly, the chart, I love the chart right now. And if we get a runaway stock market to the upside, small caps have some catching up to do. So I really like that fund as the way to participate in that, as opposed to, you could just buy the Russell also. You can just buy the Russell futures. I have no problem with that. Last couple of sessions where we had stocks rising, look at what the Russell was doing. And last couple of sessions where we had stocks falling, look at what the Russell was doing. Can't separate risk from reward.
I'm glad you brought that up. And as we get towards the tail end of our time here, I did want to talk a little bit about that. I mean, everybody talks about the Mag 7 stocks and big tech and how it's been driving the market. But as you noted, there's been sort of some hints that maybe that's changing a little bit. I mean, do you think that's going to be a theme for this year? I mean, are we going to see that long sort of looked for broadening out process?
God, I certainly believe it, and I hope so. I am uncomfortable with such a top-heavy stock market. I know, the thesis for why the Russell is underperforming is very reasonable and valid. There's a lot of companies smaller companies that don't like higher rates. We used to say that about the tech companies and growth as well too, but somehow that went out the window with the Magnificent Seven. I am still long some of the Magnificent Seven too, but I have started a long position in the Russell, and I am. Swear to God, I remember Shana telling us, Bobby, about that CALF ETF. I'm going to be looking at that as well because I think that's very, very interesting. Again, I don't tell people what to do. I tell you what I might be doing because I do think I hope to God and do think we're going to see a broadening out. And by the way, people always look at me like, hope's not a strategy. Well, of course, hope's a strategy. It's not a very good one.
Listen, you look at the Magnificent Seven, and then you look at the FANG from a few years back. The Magnificent Seven will not stay these seven. Yeah. That's my prediction. So already you could probably pull a couple out.
Sure. Nancy Pelosi will tell us what the next one is, and then we'll just jump.
I mean, you could pull Tesla out of that now, right?
I got a smile from Mike there.
Magnificent Seven. So that's why I think that, look, if we're looking at what's going to grow in the future, it's going to be what helps productivity, because productivity is the engine, and what helps productivity is tech. The Magnificent Seven will not be these seven. So that's why I like what Jimmy says there. He's starting to look for places to get out of some of them. I like selling covered calls in a lot of them. If you have a lot of profit in them, that's something that I've been looking at doing. I haven't started doing yet. So that's my real thesis on the Magnificent Seven, is that it's going to be, this seven is going to be two. And I don't know which two it is yet.
Got it. I guess last question I'd ask you, I mean, you guys are both joining us for the Investment Master Symposium in Miami this April. Looking forward to it. I mean, sometimes you have to give these sessions sort of an open-ended name, and yours is 2 quarters, one of risk and discovery and one of opportunity. Any sneak peek at what you're kind of looking at talking about there in Miami?
Yeah, what I was going to say is that Jimmy and I are going to cover what's happened and what we think is going to happen. And one of the things that we'd like to do, and we're working on actively right now, is bringing a couple of disagreeing people that are attending the Money Show up on stage with us, because those are the people we talk to in the Futures Edge podcast. So you look at the list of who's attending the Money Show, and you look at the list of the guests we have on the Futures Edge podcast, and it's an incestuous relationship somewhat, because Jimmy says this all the time. It's one of my favorite things he says on the podcast. You might think we're idiots, but you can't deny that the people who talk to us are not. And a lot of them will be at this Money Show. So we're going to talk to them about what just happened, what we think is going to happen, and we're going to find places where Jimmy and I agree, which will be boring, and places where Jimmy and I disagree as to what's going to happen. That'll be a lot of fun.
And then we're going to put on gloves and go bare chested and slug it out on stage. I mean, that you can't miss that. By the way,
as long as somebody's got their cell phone recording, let's do it.
He's fast. Like, it's literally going to be Sugar Ray Leonard against Tyson, because he's going to hit me a lot more than I'm going to hit him, but I'm going to hit harder.
So the good news is it's on April 12th. We're going to have 2 months more of data. And I believe by April 12th, the world's going to look significantly different than it does now. I believe that my thesis about reverse repo being drawn out is going to be a lot closer to its culmination at that point in time. And I think it's going to be exciting as hell. Don't miss it. April 12th, Money Show, Miami.
Awesome. Well, guys, listen, thank you both so much for your insights. Thank you all for watching. As I mentioned, if you'd like to hear more from Jim and Bob, not to mention dozens of other top trading and investing experts, I do encourage you to check out the Investment Master Symposium. We're in Miami from April 10th to the 12th at the Hyatt Regency Miami. You can find more details in the video description below. Jim, Bob, thanks again.
Good to see you, Mikey.